Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. Start of a new week, and we begin with no resolution in sight for the US-Iran war, and Prime Minister Modi making a passionate appeal, for everyone to take collective steps to curb gold imports, foreign travel, carpool, work from home. So that's top of mind.
Well, that's right. And you have crude oil prices that have spiked up as well, nearing the $105 per barrel mark. So we've got plenty of cues, some cautionary stance coming in from PM Modi. Global Q is in a bit of a tizzy, but we've got a market to deal with. So, Prashant, let's get straight to it.
Absolutely. And, I'm going to start with not the global, but the local in that sense and take a look at what really has happened. So, Prime Minister Modi's appeal to the nation. And I'm just going to run through the main highlights. I mean, this is a longer list, but basically limit use of petrol, diesel. Just think about it. This is essentially the large import item numbers. Oil imports were $135 billion in FY26. Take a pledge not to buy gold for 1 year. That's about $72 billion in FY26. Take a look at reduced edible oil imports, well, that's about $20 billion last year. Cut use of chemical fertilizers, that's about $14.5 billion of imports last year. So, this is basically around 32% of the total oil bill, import bill for India. And this is, of course, an appeal that prices are too high and we need to sort of self-regulate before perhaps more measures are taken. Will this have an impact? I think it's a question up in the air, the appeal itself. I mean, last time the Prime Minister made an appeal with regards to, people who were better off, asking them to give up their LPG subsidies. I mean, I think a lot of people came forward. I'm not sure how much of this is going to have an impact. At the margin, perhaps it may, but we will see. The question is, does it signal perhaps more measures coming? And that perhaps is a question many are asking. Is this the precursor to actual rationing? Is the situation in terms of inventory drawdowns, etc., at a level now that actually is availability an issue? And so far, it's not been that way. So the Essential Commodities Act was invoked with regards to LPG. That was rolled back, and we went back to as things were. So, sitting where we are right now, perhaps not rationing across the board, but maybe fuel price increases, right? Petrol, diesel price increases. And frankly, it's kind of surprising that we've not seen hikes so far. Elections were on, but elections wrapped up more than a few days ago. So, in that sense, perhaps to my mind, I think fuel price hikes imminent at this stage. Focus to try and manage the current account deficit, which of course is, experts have all pointed out is the most important macro variable for India. The numbers are pretty stark, right? Every $10 rise in oil is a 0.5% negative terms of trade. And how this negative terms of trade shock impacts GDP depends on who takes the hit. So far, the government has taken the hit. Corporates have not, the consumers have not. So will that kind of sort of spread through now with these fuel price increases? At $100, and these are estimates across the board, the current account deficit could be between 2 and 2.5% of GDP. And I think those are the numbers which the government, of course, is also looking at. Now, in terms of what is causing all of this, right, which is the Iran-US conflict and the no resolution, well, there is no resolution. So over the weekend, Iran sent its response to the US proposal aimed at ending the war. So US sent a proposal, Iran responded, and Trump has responded now this morning saying, I don't like it, totally unacceptable. And this is the problem. I mean, oil's spiked up about, as you can see, $104, $105 or so this morning. And the silver lining in terms of some positive could be that there was a 3-day ceasefire between Russia and Ukraine. It ends today. The ceasefire ends today. President Putin said, well, I think the matter is coming to an end. I mean, the matter being the war which has raged on since 2022. But we don't know whether this ceasefire is going to be sustainable. We've had previous instances where it's not been sustainable. But in any case, I mean, it's gone on for 3-4 years now. It's not the prime mover for oil prices or gas prices, et cetera, et cetera. Maybe for defense companies in Europe, et cetera, it makes a big difference. Yeah, sure. I mean, if these entities are unsanctioned by the US, countries like India get to buy Russian oil and gas. But in terms of just sheer pricing, energy pricing, I mean, it's not the real deal, of course, is the Strait of Hormuz and not Russia, Ukraine. US markets hit all-time highs. So S&P was up 0.8, NASDAQ 1.7. Jobs numbers were strong. And I mean, the chip and AI trade continues. Micron was up 15%. Memory prices surging. We put out a piece on Editors Roundtable on Friday. Intel was up 14%. Perhaps there's a chip manufacturing agreement, a deal, Wall Street Journal reported, which they are close to signing with Apple. The range for the market remains largely similar. So 24,300 on the upside. But beyond that, the high is 24,482. So I'm putting that out as a resistance. And on the downside, 23,800 and about 23,550 odd are support levels. GIFT Nifty gives you a quick sense of how we're likely to start. I mean, today you will see various sectors moving, some sharper than, jewelry stocks and perhaps oil stocks and, airline stocks and hotel stocks. You will see all of that based on what the market will make of Prime Minister Modi's speech and the measures which perhaps are coming. But I think one thing, is certainly there that, fuel price hikes are required. The government's kind of sort of, taken the hit so far. But now I would imagine that needs to be done because the only way is to regulate, and you regulate when prices become high and you cut back on spending on that particular item. So we'll see when and how and the quantum in which that comes. Nigel has walked across to the wall with the futures and options positioning and the commentary. Nigel, take it away.
Well, that's right. Post the commentary that came in from Prime Minister Narendra Modi, we have seen that the GIFT Nifty is suggesting a bit of a pullback of close to around 200 points. But I would read the comments more of an appeal and not macro instability. I would think some small curtailments are possible, nothing worrisome as of now. So basically, it's more of a cautionary stance, not a big worrisome factor, at least as of now. That's the stance that I would take, and that's why I would believe that still this uptrend is more or less intact. Let's focus on a couple of data points that we got in Friday's trading session. The DI buying, that outweighed the FI selling, and that's why you had 1,500 to 2,000 crores of institutional net buy number in Friday's trading session. But the FIs, they're extremely cautious in the F&O market. I say this because they added short positions both on index futures as well as on stock futures, and there was some unwinding of long positions as well on both those two. In fact, if you just pull up a chart on index futures, you'll see that the shorts are up by close to around 40,000 contracts since the start of the series, and at currently 2.1 lakh contracts on the short side. The FI short position is the highest we've seen in the last 1 month or so. In percentage terms as well, they're aggressively net short. Close to 88% of their positions are on the short side. I say that their stance is cautionary because not just they're shorting the index, they're also writing more calls than puts. That tells you in the near term, they don't believe that we can get past the 24,500, 24,800 odd mark. Even in Friday's trade, they wrote close to around 4 calls for every 1 put, in Friday's trading session. So a lot of writing is what we're seeing on the call side. Now, that 23,800 mark, that's important, and the reason I say that is because the recent lows, it tallies around there. So you don't want this 23,800 odd mark to get breached on the downside. For me, that's the first reference point in terms of a support level. And I think at some point of time, that 200, 250 point downtick that you see could get bought into. I mean, you'd like to see this level of around 23,800 hold out. The Nifty Bank, that's actually been a little bit under pressure. And in the last few trading sessions, that slipped a little bit. And now it trades below its 20 as well as the 50 DMA. And that's telling you that it's facing resistance at those levels. We focus on the Nifty Bank and the frontline indices. But the real action has been in the broader markets because the advanced decline ratio in May is good. It has turned, remember, for the better in April after 6 months of seeing the number of stocks declining, outweighing the number of stocks advancing. So you'll want to see more of the same with regard to the broader market action. Maybe today you'll see individual stocks that are under pressure, but I think the broader markets have their mojo back. And even last week you saw the small and the mid-cap indices do quite well. So for now, PM Modi's comments, more cautionary rather than suggesting any kind of instability in terms of economic factors.
Thank you very much for highlighting that. It's also going to be an important global week. So U.S. consumer price inflation report for April will be out on Tuesday. Expectations are for a 0.6% month-on-month increase, and this follows a 0.9% increase that we had in March. So March did have an impact, but April will be the first full month of the war impact in terms of costs and inflation on U.S. And secondly, the big one is the Trump-Xi Jinping. The two-day summit will begin on 14th and 15th of May. High-stakes meeting, implications for tariffs, Iran war, Taiwan, and the AI war between the two nations. But back to the big story. Prime Minister Modi has issued a national advisory addressing a public gathering in Hyderabad. Mr. Modi framed the appeal as an economic and national responsibility. Listen in.
साथियों, हमें पेट्रोल डीजल का उपयोग कम करना होगा। शहरों में जहां मेट्रो है, वहां हम तय करें कि हम मेट्रो का ही उपयोग करेंगे। ज्यादा से ज्यादा मेट्रो में ही जाएंगे। अगर कार में ही जाना जरूरी है, तो फिर कार पूल करने का प्रयास करें और भी लोगों को साथ बिठा ले। अगर हमें कहीं सामान भेजना हो तो कोशिश करनी है कि वह ज्यादा से ज्यादा रेलवे गुड्स के जो ट्रेन होती है, रेलवे की सर्विसेज से भेजे। जैसे आजकल जो विदेशों में शादियों का, विदेशों में घूमने का, विदेशों में वैकेशन पर जाने का मिडिल क्लास में कल्चर बढ़ता जा रहा है। हमें तय करना होगा कि जब ये संकट का काल है और हमारी देशभक्ति हमें ललकार रही है, तो कम से कम 1 साल के लिए हमें विदेशों में जाने की बातों को टालना चाहिए। भारत में बहुत सारी जगह है, वहां हम जा सकते हैं। एक जमाना था जब संकट आता था, कोई युद्ध होता था, तो लोग देश हित में सोना दान दे देते थे। आज दान की जरूरत नहीं है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे। विदेशी मुद्रा बचाने के लिए हमारी देशभक्ति हमें चुनौती दे रही है और हमें इस चुनौती को स्वीकार करते हुए विदेशी मुद्रा को बचाना होगा।
Dr. Soumyakanti Ghosh is with us, Group Chief Economic Advisor at State Bank of India. Dr. Ghosh, good morning. Good to have you with us here. Thanks for joining us. So we've heard the Prime Minister make that appeal. So 2 questions. One, do you think this will make a difference, make an impact, make a dent? Second, is this a precursor to some actual rationing measures, fuel price hikes? Maybe, yes, as a mechanism. But in terms of actual rationing, is there reason to worry? We've seen lots of countries in Asia do it. We've avoided it so far. Your thoughts?
Yeah, thank you, Prashant. Good morning, and thank you for having me on the show. I think I'll look it at it a little differently. I'll not say it's rationing, but basically it's an appeal to save the precious foreign exchange reserves. I think the numbers and the war continues to happen, and the recent statements actually doesn't augur well for the war to end anytime soon. So given this context, I think some sort of an decline in the foreign exchanges use could actually go a long way in preserving the current account deficit. Because just some number I want to tell you, I think at $100 per barrel, if that is the average, the current account deficit hits 1.5%, growth hits around 6.6%, and inflation hits 4.6%, which is the current assumptions of the Reserve Bank of India. So any numbers beyond 110 actually pushes the current account deficit towards 2%, and the danger is actually when the crude touches 120 to 130. But these are assumptions for the full year. So in my sense, at this current level, yes, there are concerns on the growth, but current account deficit and inflation are still manageable. But my sense is that there are some steps which are required so that the external sector remains cushioned and possibly somehow insulated from the current West Asian crisis.
So in terms of actual measures, this is an appeal, but in terms of actual measures, is there any way to tell whether we'll see something? On LPG, we saw something, right?
Yes, I think, Prashant, some sort of steps could be forthcoming. I think on terms of the hike in the oil prices, I think that could be one of the last options. But if you remember the 2013 taper tantrum crisis, there were several steps. There was a bouquet of steps apart from the short-term interest rate hike of 300 basis points. Then there was the FCNRB deposit window. Then there was also restrictions on the LRMS, basically that capital account transaction, which the Honorable Prime Minister has been talking about. So I think there were some restrictions. All of this came through. And after that, I think rupee staged a smart recovery. So whatever steps the government or the central bank will take, I think that will be in unison. And we don't rule out some of the steps which were similar to what happened during the 2013 crisis.
Okay. Mr. Soumya, morning. This is Reema here. Prime Minister Modi also particularly called out on import of gold. He said avoid buying it, makes an appeal to avoid buying it for nearly 1 year. Do you think that could be a precursor perhaps to a hike in import duty on gold? We've seen it in the past. It happened in 2022, then it was rolled back in 2024. Do you have a view on this? And if it does come through, will it have a tangible impact?
Reema, I think I will make 2 points over here, one related to gold and one somehow not related to gold. On the gold, I think it's always a very tricky issue. I think if you remember in the past also, whenever the import duty has been hiked, I think there has been always I think the problem of the secondary market of the imports going up. So I think it is going to be a tricky, and it remains to be seen how that is tackled. Whether there is a counter-cyclical increase in hike, basically the way where I think we had those hikes which were done earlier when the crude prices went down and went up. So that is one option. The other option is on the capital, I think there was a lot of talk about the FCNRB deposits and other things. I don't know whether that's a feasible option or not, given the significant increase in cost right now. And the third option, possibly, there are many other options. Third option also possibly, as there has been reports of suggesting that capital account restrictions, if you actually pull out the data, the overall capital account outflows in the LRMS regime last year could be well in excess of US 20 billion, out of which 75% actually is because of factors like equities, immovable properties, travel, and other things. So maybe, and it was, I think the same thing happened also in 2013. So maybe some steps on that account. But my sense is that it could be a combination of several steps, maybe a graded approach, or maybe together, so that the news goes that we are there to help the external sector cushion the shocks.
All right. Good morning, Mr. Ghosh. This is Nigel on this side, sir. Thanks for joining in this morning. Quick word with regard to the Indian rupee. You briefly mentioned about that, and there were some reports that suggested in the past that maybe a forex bond issue could be on the anvil. Do you think we'll be looking towards that direction, or do you think not needed as of now?
I'm not sure about the bond issuance at this point of time, because if we compare with the 2013 crisis, and the current swap cost, the hedging cost, the rate of interest globally, I don't know how much will be the increase in, how much will be the cost of that FCNB deposit mobilization. That is always an option on the table, but we have to be also significantly mindful of the cost involved in the mobilization of a deposit-like scheme at this point of time, because things are completely different from what it was in 2013 and what it is in 2026.
Okay, so on gold, Dr. Ghosh, there is a chance of a import duty hike?
Possibly there could be a possibility. I'm not sure. I'm just guessing there could be a possibility. But as I said to you, that there is always a problem of an this black market and secondary market.
Yeah. Every measure will have this. I mean,
But
the
one
so-called-
option is that, Prashant, I want to mention is that already the banks have a scheme of these gold loans. So maybe some changes in the gold loan scheme to make it more attractive.
And LRS also, you said something similar to what was done in 2013, possible.
2013 for a temporary period is possible. It's just guess estimates. I'm not sure, but that I just said the numbers in front of you.
Yeah. Now, the other thing was you said FCNR like scheme, right? I think Bloomberg reported 2-3 days back saying that it's not a FCNR type scheme, but maybe a dollar bond issue. So that is different. I mean, that is deposits, this is debt. You think possible?
I think in terms of the cost involved, if you look into the 1919, the Millennium bonds and other things, I think the cost involved even in terms of a bond issuance are going to be on the larger side. So that's exactly the point. So even if it's an FCNRB deposit scheme or it's whatever is a bond scheme, any fund mobilization schemes in whatever form will involve explicit cost, and for that I think the last time, if you remember, the central bank bought the hedging costs, and also the central bank there was the exemptions on the regulatory dispensation. So I think even if you rule out those regulatory dispensation and the cost, the implicit cost which will actually entice the depositors to come into India will be on the larger side. But I think that's always an option which is on the table in times of foreign crisis. But I'm not sure whether that could be the option, the first option now. Maybe some graded actions, later on see how it takes from there. And
in terms of petrol, diesel price increases, small adjustments, right?
Nothing. I think petrol, diesel price adjustments is a possibility, but maybe the government is looking at it as an option which is not on the list immediately. Maybe at a later stage if the things doesn't improve.
Yeah, but I mean, frankly, I would have thought we should have had it by now. But they've held back and they've taken...
I think more often measured, Prashant, I think some steps may be required from the monetary policy. I'm not talking in terms of any rate hikes or anything. But if you remember, in 2013, there was a temporary period when the short-term rates were significantly increased. And that actually was one of the factors which ensured that the rupee was protected. The increasing interest rate as an exchange rate defense, as a defense of the exchange rate is not a option in an inflation targeting regime, but it could be always one of the options in a short term without resorting to any rate hikes, so that the short-term funds became more attractive. And also the fact, I think one of the important factors which I mentioned, I think also the fact on the taxation issue. I think there has been a lot of discussion has happened on the taxations and FPI. Maybe that could be also one of the options on the table from the government point of view. You remember that after 2023, it has changed, and maybe some leeway from that could make the portfolio capital.
Is there active discussion on that front, or this is just like a wish list, Dr. Ghosh?
These are all wish list, and then I think the wish list is always large. But
because if we get into wish list, it's a much longer list.
I think the measures are not significant. The wish list is not significantly large. There are only a couple, 3 to 4 wish lists. But hopefully, I think over a point of time, some of this wish list, if it's implemented, that could be better. But my only point to note is that given the current balance of payment and the fact that it will stay in the negative zone for the 3rd consecutive year, we indeed need a measure to comprehensively address the balance of payment structural issue.
Got it. Thanks very much, Dr. Ghosh. Appreciate you joining us and running us through what you make of the appeal by Prime Minister Modi, and of course what perhaps may follow. There are lots of things, lots of tinkering which can happen. We'll see how much of it happens. But Dr. Ghosh, of course, gave us a framework in terms of how to think about some of this stuff. Well, let's just put out some of the stocks we're going to address on Top 10 in just a bit. Tata Consumer Products, Bank of Baroda, MCX, JSW Infra, Balkrishna Industries are stocks on our radar. On the positive news flow front, jewelers, OMCs, travel hotel names, Swiggy, ABB India are stocks on the radar, likely to open in the red. Coming up, all of it with our research team on the other side.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC-TV18's list of top stocks for the day. Mangalam, you go first. And good morning, guys. Do you expect an impact on the jewelry companies?
Yes, I do. And that's because the Prime Minister has urged the citizens to go ahead and defer purchases of gold jewelry in particular for the next 1 year. This move is obviously aimed at protecting forex. India imports about 60 tons of gold every month. So if citizens were not buying gold, then maybe this could save on forex is the intent. There would be a sentiment impact of this. But what the real impact will be is that analysts are saying that this could actually be a precursor to the government in some way or the other announcing some curbs for gold imports. Way back in 2012 and 13, where we were in a similar situation, the government over the course of 12 to 18 months had increased customs duty on gold import from 2% all the way up to 6%. So all these factors would put a bit of a brake on the kind of moves that we've seen on all the jewelry stocks. Remember, over the last year or so, the one thing in the consumption space which was shining bright was the jewelry space, with all the companies seeing over 40-50% growth. A large part obviously led by gold prices, but buyer declines did not happen. So all these factors, given the sort of outperformance that we've seen and the fear that there could be some curbs on imports, will keep these stocks gains in check. In fact, I would see some correction on these counters.
All right, thanks a lot for that, Mangalam. Well, let's hop across. We'll also be joined by the management of Senco Gold in just a bit. Mr. Suvankar Sen will be joining in to help us with some insights on that front. But moving across to Sonal, she's here to tell us about OMCs and travel and tourism as well could get hit. Hey, Sonal, good morning.
Good morning, Nigel. Well, yes, important advisory coming in from the Prime Minister. The advice is on fuel conservation, work from home and domestic travel versus international travel unless necessary. He's asked public to use cooking gas, diesel and petrol judiciously. Now, remember, last week itself, we got numbers from the Oil Ministry where they indicated that oil marketing companies are incurring losses of 30,000 crore rupees per month on sale of auto fuels. So that's the level of losses made by these companies. So all eyes now will be on pricing of petrol and diesel from here on. And crude oil prices have also jumped, so the losses are only getting wider. So all these stocks will be on our radar. Oil marketing companies continue to be under pressure. Now it could be a volume hit as well. And of course, travel stocks or hotel stocks will see some green because of big push for domestic tourism.
Thank you very much for that. Back to Mangalam. Tata Consumer, solid set of numbers.
A very good set of numbers coming in. In fact, one of the best that we've seen in the consumer space so far. And given its size, 16% underlying volume growth as against street expectations of just over double digit is something that the street will definitely like. And if you look at across the board, there was a strong beat coming in on the revenues, which came in at 5434 crores. The street was working with a number of 5270 crores, so an up move out there as well. EBITDA shy of 800 crores. The street was working with a number of around 750 crores. The margins have been a beat as well, and on the back of which the net profit, our poll indicated a number shy of 400 crores. The company has gone ahead and reported 424 crores. What did well for them? India Beverages out there, volumes grew 4%. The expectation was anywhere between 3 to 6%. India Foods, volume growth at 15%. Here too, the expectations were 10 to 12%. And a large part of the growth was led by some of their growth businesses. Sampann actually grew 69% as against expectations of 35 to 40%. So seeing green on Tata Consumer.
And Bank of Baroda, let's find out how the numbers looked. SBI was a big disappointment on Friday. Ritu joins it with her analysis on Bob.
Well, Reema, it was a healthy quarter for Bank of Baroda. Profits grew by 11%, and that was led by a very good growth, actually much better than most of its peers when it comes to the loan growth. There was margin expansion, lower OPEX, and that offset some of the weaker treasury income that we've been seeing across public sector banks. The core income, net interest income grew by 8.7%. Loan growth was at 16.5%. Margins expanded to 2.89%. Asset quality also improved. Gross NPA at 1.89%. Net NPA even lower at 0.45%. The bank used some of the IT refunds it got in the quarter to create about 1,500 crores of floating provisions to strengthen its buffers ahead of the ECL guidelines coming in. And going ahead, margin is expected to stay in this range of 2.75 to 2.95. Credit growth is raised to about 12 to 14%, and deposit growth at 9 to 11% for FY27.
So thank you very much for that. Good quarter and a guidance raise on the credit growth going forward to 12 to 14%. Back to Mangalam on Swiggy.
Well, Swiggy is a mixed set, because their food delivery business did extremely well, 22.5% plus. GOV growth. The street was working again with a number between 18 to 20% because of their guidance, and it's industry beating. It's done better than Eternal as well. There was margin expansion, but quick commerce, on the other hand, actually reported slower growth than peers because the companies said that they are focusing on profitability. So if you look at the reported numbers, they're in line with what the street's estimated range was. Revenue of closer to 6,400 crores, EBITDA loss of around 700 crores, net loss of around 800 crores. Nothing that the street wasn't anticipating. But here, the mixed nature of these numbers will perhaps keep the street on tenterhooks when it comes to stocks, because food margins expanded. Gross order value grew 22.6%, but Instamart, NOV grew just 60%, was the expected 80% plus growth. EBITDA loss, it was in line with street expectations of 800 to 900 crores. And if you compare it now to Eternal, the food delivery business is comparable, 22.5%, 22.6%. But quick commerce, look at the gap. Eternal grew at 95% at a much larger base, whereas Swiggy grew just about 60%. And Eternal's contribution positive, whereas on an NOV basis, Swiggy is minus 2.5%. They have half the number of dark stores, but they still have enough cash. So let's see how the stock goes. I'm going with a mild red on Swiggy because of the weakness that we've seen in quick commerce.
All right. Mangalam, thanks very much for that. Well, let's focus on ABB, which was, I guess, a little disappointing with numbers. Vinny is here with details. Vinny, morning.
From ABB in Q1 calendar year 26, miss on all the fronts that you're seeing, whether you look at revenue, profits, or the margin of the company. Now, margins, obviously, this time they were impacted. Why? Because there was raw material inflation, rupee depreciation, revenue mix, as well as pricing pressure. So margin contraction and came in at around 12.85% versus 18.6% last year. Now, order inflow, that continued to do well, right? We're seeing a 25% growth in terms of order inflow. 4,280 crores is what the orders stood at. What was supporting it? Orders came in the data center space, railways, renewables, utilities, infrastructure segment. Do not forget, from this quarter onwards, the company has actually completed that sale of the robotics business as well, which is in line with what the global parent ABB has also been doing and has announced as well. Concall highlights also came in. They said that there was an impact of West Asia that came in. PAT margin guidance that they gave for the next year would be in the range of 12 to 15%. The company has taken price hikes already, and they could consider some more in terms of the price hikes as well. Large projects, they highlighted that they were seeing some ordering continued, but with some elongated time for decision making. So delay in decision making was a concern. Automation, industrial capex projects, especially, that they were seeing some bit of a delay coming in. And automation segment, that's why has seen a bit of a weakness this time as well. Competition that came in from Korea, Japan, China, that continues as well. So that will be key to watch out for. But weak set of numbers, and brokerages have downgraded the stock as well.
Okay, all right. Thanks a lot for that, Vinny. Well, let's hop across to Divyani. She's here to tell us about MCX. Those numbers look quite good. Divyani?
Well, strong growth coming in from MCX, and that's despite a high base that was set in Q3 of FY26. Now, keep in mind, commodities by themselves had a great quarter, ended March 31st, 2026, and with gold and silver touching all-time highs globally, massive intraday volatility that was seen across bullion, crude, that is energy, as well as metals, primarily on the back of the West Asia tensions. And as a result, average daily turnovers have reached 5.4 lakh crores for the full year FY26. Now, this is also reflected in the numbers seen by MCX, with Q4 actually beating estimates across the board against Bloomberg estimates. Now, revenue came in at 889 crores, up 34% on a quarter-on-quarter perspective, with EBITDA coming at 666 crores, up 35% on a quarter-on-quarter perspective, with margins expanding to 75%, up 50 basis points since last quarter. Now, net profit reached 530 crores this time around, up 32% since last quarter. All in all, a strong showing from the company, going with the green on MCX in trade today.
Okay, well, JSW Infra in focus. Devani, thanks for that. Vivek has got this one. Vivek, morning.
Well, good morning. Remember, JSW Infra had highlighted during the course of the quarter that one of the terminals in West Asia had been impacted, and the street was fearing the worst in terms of numbers. But the numbers have come in healthy, and the company has managed to meet its FY26 EBITDA guidance. Revenues high by 18.5% on a year-on-year basis. EBITDA up by 20%. Margins quite strong, a 50 basis point improvement. Profitability down by 18%. This on account of a 68 crore hit that the company took on account of the hit that they faced in the liquid terminal at Fujairah. Cargo handle volumes managed to go up, inch up almost 1% on a year-on-year basis. The company has given granular details for FY27 in terms of the guidance. Revenue expected at 6,850 crore, operating EBITDA at 3,000 crore. One important thing to watch out for in JSW Infra would be the management efforts at going ahead and diluting stake or reducing stake, and this could probably be via an offer for sale route or an equity raise route. JM Infra has gone ahead and said key triggers to watch out for as far as JSW Infra is concerned is tariff hike at Mangalore, ancillary services, group cargo performance, and the ramp up in the logistics segments. Remember, they've recently acquired Navkar as well, going with the green.
Thank you. And one final one, Balkrishna Industries. Sudarshan joins in with the numbers.
Good morning. So it was a steady set of earnings from Balkrishna Industries and supported by the volume growth that company has seen for second straight quarter. In Q3, it was up 6%. This quarter too, it has increased by 5%. And because of that, revenue has increased by 7%. EBITDA too has seen a jump of 5%. Margin continues to remain hold the levels about 21%, 21.4% versus 21.9%. But beyond the earnings, company also has given the outlook for 2030 and expects revenue to increase 2.2 times and margin after completing everything that company is planning to remain in the range of 23 to 25%. So I'm going with green.
Thank you very much for that. Lots of stocks, all important ones to track today. We can't, can't take our eyes off from crude. Crude prices are rising. Manisha joins in to tell us what's happening.
Morning, and thank you for that, really. As we've seen, quite a surge coming in. Remember, last week was nearly 6% of a decline. This is after US and Iran, in some sense, agreed to a peace proposal, is what the markets thought. But clearly, it is not happening with the kind of statements we've seen coming from US. Now, the original US proposal, as per report, says that they're asking Iran for a 20-year halt to Iran's uranium enrichment activities, removal of highly enriched uranium stockpiles as well, and dismantling of key nuclear facilities in exchange for sanction relief. Now, Iran's been asking for an end to U.S. naval presence, lifting of sanctions, security guarantees, and recognition of Iran's right to continue some nuclear activity, clearly not meeting on a middle path for both of those countries there. In the meanwhile, you have the world, which has lost 1 billion barrels over the last 2 months. There are renewed clash that we saw in the previous week as well. And then a state Kuwait's army saying that they have detected and dealt with several hostile drones in the country airspace, seem to be adding geopolitical premium back in case of crude oil prices. The street will, one, watch out for development from this. And then, of course, the U.S. President's Beijing meeting, which is between Wednesday to Friday. The focus is likely on trade, Taiwan, and the Iran conflict. So there's a lot to watch out for. Within all of this, we've seen strength come back in case of dollar index, which is weighing on various other commodities. And then you have the China producer prices, highest in last 4 years, kind of supporting the metal prices. So when you look at copper, that's up 1%, and many other base metal prices trading in positive as well.
Thank you very much for that. Get into a break. On the other side, we'll connect with the management of Senco Gold to discuss Prime Minister Modi's advisory on gold purchases amidst the West Asia crisis. Stay tuned.
All right, welcome back. Well, with gold, with tensions escalating in West Asia and fears growing over disruptions in global oil supplies, Prime Minister Narendra Modi has issued a national advisory. The Prime Minister also stressed on reducing gold purchases, saying gold imports consume a large proportion of foreign exchange. To discuss this and see what exactly could the impact be if in case there is some curbs, we're now joined by Mr. Suvankar Sen, who joins us on the show, the MD and CEO at Senco Gold. Hi, Mr. Sen. Good morning. Good to see you, Ben. What do you make of Prime Minister's comments? Are you bracing for some kind of import restrictions on gold? Your initial comments.
So, as citizens of the country and members of the industry, we need to understand that, based on what, situation our Honorable Prime Minister has been, announcing these various curbs. It is the Middle East crisis, which doesn't seem to end while everyone is hoping for peace and the crude oil prices going up. The bills for import of crude oil is going up. So I think that maybe for a short period of time, we all must, as citizens, try our level best as industry that how we can help the nation to overcome this challenging situation. We need to keep certain facts in mind. One is that, in the whole of last year, if we look at the import of gold, and especially the import of gold related to jewelry consumption, it's down by almost 20%. Even the Q1, as per World Gold Council report, we've seen that the consumption of jewelry and the gold import related to that is down by almost 20%, 14 tons, and the investment demand has been higher than the jewelry demand. So that is number one. Number two is that in the industry overall, if you look at it, about 50% of the consumption is led by old gold exchange. So therefore, it's not that consumers are buying with their money, but also exchanging their old gold. And as an industry, we've been in talks with the government for quite some time. And I think that right now it is more needed that the government and the industry comes together on ensuring that this 20,000 tons of gold and more than that is lying in our economy, lying in our country in various forms, whether it be household gold, temple gold, how we can use those gold and then use it for the industry, because for the industry, it is providing jobs and employment to so many karigars. It is a source of income from exports. So the gold lying in our economy itself is a great resource, and we can aram se reduce the import if we can use the gold lying in our economy. As an industry, we are promoting and exchange, ensuring that the consumers are exchanging their old gold.
Subankar,
so that's how it is. Yes.
So the import of gold for jewelry consumption, how do you different? I mean, you said it's down 20%. How do you differentiate? Gold comes in as gold, right?
Yeah, gold bars are coming in, but then as per the research, whether it is going to ETFs, whether it's bought by mutual funds or, for investment demands for bars and coins. So there are these research reports done by World Gold Council that states that, okay, so much of quantity of gold is used in investment purposes and so much quantity of gold is used in jewelry purposes. And that is where it has been seen for the first time in the last quarter that the investment demand has been higher than the jewelry demand. Okay. Usually, jewelry is about 40-45%, but this particular last quarter, it's been about 25-30%, while the investment demand went up by 50%.
And 50% of what you said, gold jewelry sales in India is led by exchanging of old gold, basically, right? That's what you said. Exactly. This is across the board. Exactly. Yeah. Okay. Do you think there will be import duty hike?
Well, based on our Prime Minister's thought process, if there has to be certain policies that has to be done in order to discourage, import of gold, duty hikes could be a possibility. But till it is being done, these will only be, speculation whether it will happen or not. But because there is another, at the other side, there is a World Trade Organization mandate across the various countries that we must reduce duties on gold. So that is one mandate that is going on. Parallelly, this crisis is also there. So it's a speculative thought process, but it is always a possibility like the past.
So just hypothetically, going with the possibility that there is perhaps an increase in the customs duty on gold imports. It's happened in the past. And when it did, can you tell us how did the imports of gold come down by? To what extent? And did it slow down growth for the organized sector?
So, 700 to 800 tons, no matter what the prices have been. Because out of the import of 700 to 800 tons, about 20-25% of the gold gets used up for exports, and the remaining 75% is used up in either domestic consumption for jewelry or for investment. So it will maybe create a dent of about 10 to 12% reduction in terms of the volumes that gets imported. So that's one impact that we must take. But from an industry perspective, I must tell all of you that over the last 1.5 to 2 years, anyway, the industry is working towards, because the gold prices are so high, that how we can ensure that the consumers can keep buying. So we are reducing the weight ranges of our product. We are trying out with 9-carat jewelry, 14-carat jewelry. So if we can go back to those olden times in 1970s and 1980s, when there was gold control, then that was the time when a lot of stones were being used in the jewelry. The purity of the jewelry was lower. Right now, hallmarking is there for 9-carat, 14-carat, 18-carat. So even the consumers are opening up to experimenting with lower caratages for the jewelry that they have. I think that, yes, till this war is over, industry, consumer, government, we all work together and ensure that, yes, as long as the industry's income comes from the making charges. So as long as we can make the overall budget lower, and can ensure that the job workers are getting the jobs and the industry is going on. But
Mr. Sen, sorry to interrupt. So you're saying that if there is an import duty hike, there is a possibility of a reduction in volumes, and your guess would be 10 to 12%. You also made one statement, and maybe I missed it, I didn't hear it correctly. You're saying India will import 700 to 800 tons irrespective of the gold price?
That's been the historical past. If you ask me, I think this particular year, because seeing the Q1, like Jan to March, the import that has been done, it is around 140 tons approximately, which if you can multiply it by 4, then maybe this particular year gold import will come down to around 550 tons approximately in a conservative approach. So we can already see that the import of gold is going down in our country.
Yeah. Got that. Absolutely. And good that you came on and answered some of this stuff and spoke with us freely. Always appreciate it, Suvankar. Thank you very much for joining us here on CNBC-TV18. It's a pleasure. So we'll see what comes through. But, I mean, you know, the appeal from the Prime Minister is clear, cut back. And it's with gold, it's with oil, it's with a bunch of other things as well. We'll take a quick commercial break here. We're going to come back. Dharmesh Kant of Chola Securities is going to be with us for some fundamental stock conversation in just a bit. Stay with us. Okay, welcome back. Dharmesh Kant is with us with a quick sense of things. Dharmesh, everything which has happened, let's identify where stock-wise, where action, or maybe group of stocks where action will be most concentrated in. How do you think about it?
Yeah, very good morning to you, Prashant. Thanks for having me for the show. I mean, the appeal which was made by the Prime Minister is quite scary if you put the dots together. I mean, 45 days back, he has addressed thrice that ye lamba chalega on the war in the parliament as well as in the public address. And now this appeal has been made with the unit economics goes to even, you know, individuals making a foreign travel and consuming gold for marriage ceremony, which is quite sentimental for Indians. So it's a very strong appeal. Usually appeal is followed by, you know, the rollout, depending upon the acceptance of the appeal, which happens. So this is quite scary. We have highlighted this in our 38th of March strategy note about the things which is about to come and how it was tackled in 2013 when FCNR and gold import duty hikes and everything was there. Maybe that is in the offing. As of now, to our mind, I mean, going by it, Prashant, when this is rolled out, when the appeal turns into a rollout, I think that will mark the bottom of the market, because then you know what the hit can be there, the measurements are already in place, and the fundamentals are still strong of the economy going forward. So that is what has happened in the COVID. The day the lockdown was announced, that was the day of the bottom of the market. So we are looking at it constructively, maybe a couple of weeks of more volatility. But where the numbers have panned out, I mean, I will just give a highlight of Q4 numbers. Around 320 companies we have measured on aggregate basis, which is ex-Nifty. There for the financial year, the number has grown by 15% on a PAT basis. But if you look at Q4 numbers, it has grown by 33%. So, I mean, underlying fundamentals of the economy has been pretty strong. Only Nifty 50 has been a bit softish of around 7.5% kind of a growth. But otherwise, it's going strong. The jewelers will definitely take a hit today, depending upon what the appeal has been made. But apart from there, I mean, stock-specific plays should out be there on the positive side.
Hi, Dharmesh. Good morning. Good to see you, Ben. Well, SBI, that was a big casualty, right, on Friday. The street didn't like the numbers too much, and the stock really took a sharp knock. What's your take on the numbers, and how would you approach the stock? Now it's closer to around $1,020 in comparison to that $1,150 earlier.
Yeah, good morning, Raj. I mean, that's the problem. Q3 numbers of SBI was still a set of numbers, and then we saw a strong uptick in the stock price. And see, it's a very big company, around 50 lakh crores of AUM is there. And on that basis, 1,000 crores of slippage is minuscule to my mind. The numbers were not that bad. The problem with all the banking space, if you look at the numbers consecutively, is like that. The advances growth has been around 15-16% on an overall basis, but the net interest income growth has been in single digit or high single digit, and that is where the problem is rising, because that percolates to a lower, profitability of pre-provisioning operating profit. Why this has been there? Because of a declining interest rate trend. This is normally the scenario. I think from here the interest rate will be stable if it is not hiked by the measures taken by the government. So it's a buying opportunity to my mind. But the best number which came out from the public sector banking space was of Bank of India with 16-17% kind of an advances growth and 10% plus NI growth. 10-11% kind of a profitability growth. So I think, and they have already made most of the provisions. And valuation wise, it's cheap. It's trading at 140 rupees stock price, which is 0.7 times price to book value on the TTM basis. So a catch up can happen there. So any declines in the market, I mean, should be used to buy both. I mean, SBI and Bank of India.
All right, and I think you were positive on Bank of India earlier as well, and then I think the stock went up and then you advised profit taking, but you're saying it's providing a good re-entry opportunity at around 140 rupees. Is that correct?
Yes, sir. Definitely. Yes, Nigel.
And you would be looking at a target of?
So initial target now, since the numbers have rolled out, it's been revised to 170 now on the 1 year forward basis.
Okay. All right. Quick word on Concord. Our Prime Minister Narendra Modi, he's also spoke about rail freight, and he was encouraging that. Now, Concord is a stock that's come out drastically from the top, but if in case there is some kind of movement towards rail freight, then from road to rail, then they could be a potential beneficiary. I think that could be one of the stocks, maybe on a sentimental basis, but it could be one of the stocks to watch for today's trading session. What's your view on it?
Definitely, yes, Nigel. I mean, warrants are trading bet at the current levels. I mean, valuation and multiples can be hard to assign because it's more of a situation specific and a cyclical kind of a trade which can play out. But looks like, I mean, petrol and diesel price hike can also be there in the offing very soon. I mean, it's about to happen. That is what our understanding is. So Concord merits trading bet, but fundamentally from a long-term basis, I mean, 2 years, 3 years, we are not very constructive on this space.
Okay, thank you very much for that. We will slip into a break. We'll come back and get in the pre-opening rates. We'll also be joined by Bernstein's Pranav Gundapapalli to talk about the key banking earnings over the weekend. We'll also connect with a technical analyst for some trading ideas. Welcome back. Brace yourself for a gap down opening. Crude prices have risen to $105 per barrel, and Prime Minister Modi's appeal sort of highlights India's vulnerability, fragility when it comes to the current account deficit, the INR, and that perhaps could weigh on the markets. Mitesh Thakkar, Sudhanshu Sukhani are now joining in for a few technical trading ideas to prep you up for the day and the weighing. Gentlemen, good morning. Thank you for joining in. Mitesh, begin with you. Still in that range on the Nifty, get pushed back a bit. What's the call?
Good morning, Neema. I think yes, very much. See, what is most important is that the indicators are still flat. And while, we've gone to about 24,480 and then bounced back from 23,800, 850 zones, I think there's no sign of a directional bias happening. So I'm presuming that this range will extend for a few more days at least. And on the upside, as I've said, 24,400 is the level above which a closing can at least signal some kind of upside. But till that happens, I think we are in this 23,850 to about 24,400 kind of a range.
Okay, all right. Good morning, gentlemen. Sudarshan, coming across to you. What's your view? Be brave, don't be brave. What's it like?
Good morning. Don't be brave.
Don't be brave.
Nigel, first we went to 23,800. That was a correction. It was a buying opportunity. The second time we went there again, it was a test of the lows. That test was successful. The Nifty went up 700 points. Now, why are we going there for the third time? That's a cause for big worry. So this is not a buying opportunity. This is something we have to wait and see if is 23,800, 850 going to hold, or has the market finally decided on a direction which may be on the downside. We don't know, but we don't want to buy and find out we were wrong. This is a complete avoid now.
Stocks, Sudarshan, would you play the stocks? Because there's so much action, momentum in the broader markets, the mid caps, small caps.
You asking me?
Yes, Sudarshan.
Okay. See, stocks normally follow the broad market, the Nifty, but within that, there are buying opportunities. Astral is a buy with a stop under 1535. HDFC AMC is a buy with a stop under 2790. There are two short sells. Policy Bazaar is a sell, stop above 1680, and KPIT Tech is a sell with a stop above 740. So two buys, two sells. Don't rush for the buys. If the market decides to go down, nothing will hold it.
Mitesh, what would your stock calls be? More long or more short?
No, I think like Sudarshan, I have two buys and two sells, and yeah, a similar kind of approach that buyings are recommended on a mild decline. So buy on Coforge if it comes down by about 10-15 points. So let's say around 1360, 1355. Buy Coforge with a stop below 1335 for a target of 1410. Also a buy on NBCC around 99.5, 99 zone. Keep a stop below 96.5. Look for targets of 105. And on the selling side is Dalmia Bharat. In fact, it was a sell on Friday as well in the closing show. So Dalmia Bharat is a sell now with a revised stop at 1855 for a target of 1760. And a sell on ABB. I think first signs of profit booking after a very good rally over here. So ABB is a short-term trading sell with a stop about 1765 and a target of 6,840.
Got it. Okay. All right, gentlemen. Thanks a lot for joining in and giving us those details. Mitesh, quick word on ABB, the sell call and the target prices?
Yeah. So the target price is 6,840 and the stop loss is just about 7065.
Suggesting it's going to start off a little lower, so I think we'll have to revisit that call. Maybe at 9:10 we'll have a relook at that because it's could be possibly starting at around 6,300. So we'll come back to you, Mitesh, with regard to that call on ABB. Thanks, gentlemen, for those calls. By the way, keep an eye out on the Indian rupee. Straight out of the blocks, it's headed towards the 95 odd mark. So we closed at ballpark around 94.5 odd. It suggests a start closer to around the 95 odd mark. That's not a very, very good sign. Some kind of weakness, but I think that was on expected lines. We'll just wait for that rate to stabilize out there. But let's turn our attention to the banking names. State Bank of India had reported a mixed set of numbers. That's the quarter four numbers. The weakness was impacted the profitability, while asset quality remained more or less stable. Let's listen in to what Chairman Mr. Sethi had to say on their quarter two performance and the way ahead.
NII impact in Q4 was essentially because there's been a repo rate cut in December 15th last year, and that has been fully factored in the Q4. That is number one. Number two, I think there's been a good improvement in our EBLR portfolio. That is also adding to a certain amount of NII reduction. But I believe that our guidance in terms of NIM being above 3% still holds good for the current financial year, and we have no concern in terms of managing those margins. So the credit growth, as we have witnessed in the last year, is going to be broad-based across the retail segment, agriculture, MSME, and corporate. The current pipeline itself gives us a visibility in terms of what could be the corporate credit growth, which gives us confidence. And as I mentioned, I think we are witnessing continued robust credit growth in the current quarter also. So based on that, assuming that this West Asian conflict has not lingered longer, we are very hopeful and confident that 13 to 15% credit growth is eminently feasible. Guidance for the current financial year also is remaining in the same level of our usual guidance of 50 basis point credit costs. And the gross and the net NPAs, as you mentioned, are the decadal lows. And we have not seen any stress at this moment in terms of the asset quality at in any sector at this moment.
Well, that's SBI for you. Big miss on numbers on NII, on net interest margins, and stock cracked nearly 6-7% yesterday. This morning, pre-open, it's flat. We have with us Pranav Gundapalli, Senior Analyst, India Financials at Bernstein, now joining in. Pranav, do you think this is going to be a one-quarter negative number for SBI and it bounces back immediately in Q1? Or it sort of lingers because the stock has gotten re-rated very sharply. So valuations are not what they were, say, 2 years back. What is the call now on SBI and your view on the numbers?
Morning, sir. I think on SBI, the NIM drop that we saw this quarter, we do think is one-off, and we expect that to bounce back soon. So not particularly concerned on the NIM, and there is a clear driver for that, including the sharp growth in corporate credit, very high rated corporate credit, which is also visible in the drop in risk-weighted assets, etc. But taking a step back, looking at the overall PSU picture, we think the risk-reward isn't that great. Given that we will see a moderation in profitability. I mean, not to the same extent as what we saw this quarter, but the direction of travel is towards a lower ROAs. And second, you also have potential headwinds coming in from ECL implementation in 27. So we'll get more data around the potential impact of that in the next few quarters. And we also have, the usual macro risks that kind of linger on. So not particularly bullish. We prefer the private sector over the public sector banks. But specific to the NIM miss, we do think it will change or it will correct in the next few quarters.
Now, we're not going to be rushing in to buy SBI post this correction, right? Or do you believe risk-reward is attractive?
We don't think the risk-reward is particularly attractive. There are probably better prospects with the private sector banks, which appear a lot more cheaper versus their history. So maybe there versus the SBI.
Okay, so private versus public sector banks is what you think. And off late, we have seen in the recent past, at least, the PSU banks actually have outperformed. But you're saying that now private is top of the list. Quick word, Pranav, with regard to these measures that could be announced in the coming days. And our Prime Minister's comments overnight, they seemed a little bit cautionary. It could slow down the economy a little bit. What kind of credit growth are you working with for this year? And any kind of rate action from the RBI is what you're factoring in?
Okay, we are not factoring in rate action. We are at around 14% credit growth for FY27. That is what we expect. And built into that expectation is an assumption of almost a stable rate regime, with liquidity being not in a borderline deficit in liquidity. So RBI stepping in to manage currency, which means your liquidity will remain tight. And hence, credit growth will remain at 14%, which means it will be slightly lower than where we are today, at close to 15 to 16% mark, and led by a generally tight RBI policy to protect currency.
Pranav, do you look at Bank of Baroda? Numbers look good. They have gone ahead and raised the guidance on advances to 12 to 14%. View there?
I think loan growth for the PSPs in general should remain higher. They should get to that mid-teens growth. Given they have excess liquidity, there is a surge in corporate credit growth, given that the corporate bond yields have inched up significantly, making banking credit more attractive. So credit growth, we don't think will be a challenge across the board. But for the sector itself, we think we are looking at about 14% growth. So which means your Baroda guidance would be roughly in line with system at the upper end of their guidance.
I guess growth also gets boosted by the ECLGS, the 5.0 scheme for many of the PSU banks. So your top pick in the banking space, one where the risk reward is most favorable?
We like Axis and HDFC. Axis more as a tactical positioning where they have the right capital and a few other things working for them. HDFC, given potential for asset quality deterioration, that remains our top pick as well. So Axis and HDFC would be our top picks.
Okay. Pranav, do you track the gold financiers?
Oh, yes. We do track Muthoot, and it becomes a proxy for gold. Yeah, sorry, go ahead.
That's true. No, Pranav, the reason I asked you is because suddenly, we have heard these comments overnight about delay your purchases of gold and maybe import duties coming in for gold as well. That could put the sector in a bit of a tizzy. Gold financiers did well when gold ran up. What's your view right now with these restrictions coming?
See, I think restrictions on gold, jewelry or import would result in a hike in price, right? So I think which actually works to the advantage of Muthoot and the gold loan segment in general. I think the concern with Muthoot would be, and gold financials in general, would be any RBI action specific to this segment. And to a broader slowdown in consumption, because most of these are, at the end of the day, consumption loans. So it's more macro risk rather than specific action on imports, because that eventually drives gold price up, which is actually good for these lenders. So don't see them as directly impacted by any potential gold import regulations compared to jewelry names or other names that are more directly impacted.
As of now, you're positive on both these two names, Muthoot and Manappuram?
We remain positive on Muthoot. There is, of course, a proxy for gold price, but assuming a stable-ish gold price, we remain positive on Muthoot.
Appreciate you joining in, Pranav. Wishing you a good day ahead. And thanks a lot for your comments on both the PSU as well as the private banks and a brief take on the gold finances as well. Have a cracking day ahead, mate. Well, let's get in. Sudarshan back on the show. Sudarshan, tell us what's your 9-10 call?
It's a HDFC AMC buy with a stop under 27.90.
Okay, got it. HDFC AMC, that's the buy call coming in. Mitesh, you want to revise that ABB call? I think we should get that rate that is settled out. And also if you have a fresh call for 9-10.
Yeah, in the morning I was not aware it will open with such kind of a gap down, so it's difficult to figure out, in pre-markets, how do we stack, how the stocks will open. So ABB, of course, you can't now take a trade if it's opening about 5-6% gap down. But yeah, I think Dalmia Bharat, if you get it, I think that's a good call in this sense out.
Dalmia Bharat. Thank you, gentlemen, for joining in. Let's talk about ABB India. That could be the casualty of the day. Vinny joins in to tell us exactly what disappointed the street when it comes to ABB India.
Hi. So yes, for ABB India, the numbers overall were a miss from what the street was expecting, what we were expecting at CNBC-TV18 as well. Revenue just saw a growth of around 5.7%. So there seems like a bit of a slower execution that's come in some of their segments as well, specifically the automation segment, which has seen a weak growth this time, and in terms of slower execution as well. Margins, obviously, that also saw an impact coming in. What impacted the market margins? Raw material inflation, rupee depreciation, revenue mix change, as well as pricing pressure. These are the big concerns that come in for the margin front. Revenue profitability also was affected by that West Asia war. Now, order inflow, that was stable at 25% growth. What led the growth there? Data centers, railways, renewables, utilities, infrastructure, that continues to do well for the company, but other segments are not doing well. The company also has, completed that sale of robotics division, so there is that one-off that comes in for the company in that case. Now, Concall highlights, they talk about margin guidance, PAT margin guidance to be in the range of 12 to 15% next year. They said they've taken price hikes already in select segments, and there could be some further price hikes, so they're considering that as well. 12% of the current order book comes in from the data center business. Large projects are seeing some bit of a delay in terms of decision making, specifically for automation as well as industrial capex side. There is some bit of a delay, and there is some competition that continues to remain from Japan, Korea and China in their segments, so that also is a concern for them. And because of all of this, we've seen downgrades coming in from brokerages as well. Prabhudas Limited has downgraded the stock to a hold. Target price is at 6,523. Nuvama has downgraded the stock. Motilal Oswal has downgraded the stock. So we're seeing a lot of downgrades that are coming from brokerages. Weak numbers, clearly.
Thank you very much for that. In pre-open, the top gainer is Tata Consumer. Top loser is Titan. That's down 3.5%. Both stocks that Mangalam looks at very closely. But Mangalam, let's talk about Tata Consumer. That's the only bright spot today.
Well, that is a bright spot today. 16% volume growth is what the company has reported as against street expectations of double digits. So it's a good set that has come in. Even if you look at their revenues, they've been much ahead of street expectations at around 17% growth. And the EBITDA margins at 14.6% as well have a mild beat as against our expectations of a little over 14% too. And all of this has meant that the bottom line has also beat street expectations. If you look at the other parameters of growth, beverages, they grew at a volume of around 4%, pretty much in line with the street expectations. But food business, their volume growth was mid-teens, and that's above what the CNBC-TV18 poll threw up. And Sampann, which is the growth business of the company, grew over 69% as against 35 to 40% sort of growth that was expected. And add to all of this, the prognosis for growth for the next year as well, leading to their go-to-market strategy for a lot of their brands is extremely good as well, and which is why the stock is higher in trade today.
All right. Mangalam, thanks very much for that. Tata Consumer in focus. I think maybe a quick read-through of all the names that we've put out since the morning with stocks which are going to open up and lower. Jewelry, maybe if you have a hotboard, sort of a quick sense of where these stocks are opening, we should have it up. Kalyan is there, Titan, Senco, etc. should come up on your screens as well. Titan is down 3.5%, and Senco management we spoke to just a while back is down about 4.5%. IOC, HP, BP, maybe just a quick look at those, and then we'll get into some of the result reactions and how they're reacting. So IOC, small, 1.25% lower on these names. Fertilizer is another pack, right? Maybe look at Coromandel, and Chambal and RCF and some of the others, and look at nothing very much. I mean, flattish, right? I mean, Coromandel, Chambal, etc., down in line with, I guess, what the market's going to start down by. First rate should be up on your screen shortly. The Nifty is going to start down by how much? 23,900 is the level on the Nifty at this point. The Nifty Bank starts at about 54,670. The small cap index, do we have a rate yet on the small cap index, or I don't think we do. We'll just wait for it. The advanced declines, this is very, very initial, but and not very much seems to be changing, but it will as we go on. Small cap index is down, 1% lower. The mid cap index is down as well. So everything is down uniformly by about 1%. Mid and small caps, of course, huge outperformance. We've seen in the month of April. Actually, the small cap index had the best April in a long time, I think in over 10 years or so. So you're coming off very, very strong gains. Of course, bounces off the lows, but they are gains nevertheless. The heat map should give you a quick sense of where the Nifty 50 stocks are starting. I think that'll be something to look at. Titan, Indigo, SBI, Shriram Finance are lower. Tata Consumer, ONGC and JSW Steel are stocks which are starting in the green. It's a 1% cut, 250 points. Rima.
Well, all the gold jewelry companies are under pressure. Titan right on top, that's a 4% knock coming through. But pull up a Kalyan, pull up a Senco, these stocks down 7-8%. So bigger cuts coming through. The street is clearly worried about a sentiment impact. Will demand get hit? Senco and Kalyan both down 8% in trade. Interglobe Aviation, so travel tourism, that's the other pocket under pressure. Interglobe Aviation, and plus there's been such a rise in crude prices. 105.5 on Brent crude prices. SBI continues to see selling pressure for the second day in a row. On Friday, it was down 6-7%, another 3% lower on SBI. Auto companies are weak in trade. So M&M and Maruti Suzuki are losing about 2.5%. Shriram Finance caters to many of these auto companies in terms of lending. That's under pressure with a cut of about 2.5%. In terms of the bank Nifty, the Nifty Bank is down nearly about 0.9%, so moving largely in step with the frontliners. On the way up, it's Tata Consumer. Stock has hit a fresh 52-week high. Stock has surged 3.5%. So that's the only one where there is some green. And you've got Max Healthcare and a couple of these IT names which are in the green. But again, not a whole lot. It's a soft start. It's a weak start. 250 points lower on the Nifty. 24,000 level on the Nifty has gone. And now we're closer to 23,900.
Got it. All right, Rima, from the broader markets, there are a lot of stocks doing a thing of their own. Quick heel, the stock is up 10%. Mr. Vijay Kedia, I think, bought into the stock, in Friday's trading session. That was what came out on the block deal. So that explains why that stock is up 10%. Rain Industries is up close to 12%. They reported their best ever quarter in multiple years, I think. So, the EBITDA number is now close to around 700 crores. A few quarters ago, they were reporting numbers between 300 to around 350 crores. Just around 4-5 quarters ago, the rough average on an EBITDA basis around 350 crores. Refinancing of debt, though, remains in the key trigger from here on. They're sitting on a massive debt of more than $800 million, but that's up 13%. Birla Corp from the cement pack, that's delivered a good set of numbers. We at CNBC-TV18 will be quizzing the management at around 10:30 a.m. today. So, stay tuned for that conversation. For the timing, the stock has popped up in trade. Niva Bupa, we'll be talking to the management in a few minutes from now. That stock up and about in today's trading session. Sterlite Technologies, a stock that started last week at around 300 rupees. This week, it opens up at close to around 400 rupees. That's the kind of momentum that we've seen on this stock, and it's already locked in upper circuit. Big up move is what we're seeing on that name. Bank of India, another management that we'll be talking to. That stock is up close to around 2%. Net, the Nifty is now close to around 250 points. Broader markets under pressure. Let's see if the dip gets bought into. But the initial reaction is negative for now, with the Nifty Bank down 650 points.
Absolutely. Let's just look at the ABB move is large, right? 9.5% lower on a large name like ABB, urban company. Lots of, all of this. Not related to oil and all the cutback appeal from Prime Minister Modi. I mean, enough happening outside of all of that as well with regards to earnings and what companies have done. Gautam Chachoria is with us. He's head of global markets at UBS. Gautam, great to have you with us here. Thanks for joining in. I mean, what do you make of it, the appeal by the Prime Minister, and do you think this is a precursor of things to come? And what things, in your opinion, if you were to just sort of think through this, Gautam, in your sense?
Morning. Look, that's what investors are talking about. That is this a precursor or not? It's tough to guess or speculate. But if we go by history, obviously India has had policy measures around gold imports. We still have the local fuel prices being behind versus where the international prices are. Very unlikely any changes happen to LRS, etc. But who knows? But that's what the investors are talking about in the morning. Is this a precursor or not?
What are you telling them, Gautam? When they're asking you this, they're looking for answers. What are you telling them?
Look, it's a question of probabilities, right? Like if you just go by history and where India's macro situation right now is and how vulnerable it is to a prolonged Middle East scenario, like measures to increase local fuel prices, I think is quite likely. Degree and extent timing is debatable, but quite likely we see increase in prices. The others, well, it depends on the tenure of the stress from Middle East. Like we will see any measures around gold, etc. I think that will take more stress possibly than what we have seen till now.
So Gautam, when you speak to investors, what else are you talking to them about? What are the key points top of mind? Like once again, when I look at the Asian markets, I can see a Kospi up 4.5%, with Samsung up 6-7%, SK Hynix up another 10% plus. I mean, what are the top talking points now, and what's your response to that?
So look, the global investors in equity markets, their sentiment, etc., are back to before the Middle East conflict. I don't think we are at a scenario where they are too worried about this prolonging. Unlike, say, crude or parts of say, currency, the equity side, the narratives around AI, semiconductors, capital goods, both narrative as well as positioning and ownership are back, as if they won't be impacted or there shouldn't be much to worry about. The broader equity risk positioning globally is more like neutralish, but back to pre-conflict levels. Not yet signs of a more bullish narrative. Like I think the pre-Middle East scenario, we had scenarios of investors starting to move from large caps to small caps globally, etc. That's not yet happening globally. But the usual or more popular holdings and narratives around semiconductors, AI, capital goods, that's back to normal trend.
Hi Gautam, good to see you. Gautam, should we throw in the towel and not expect the FI money to come back with the kind of moves that you've seen in other Asian markets, some of the emerging markets as well? They don't seem to be in love with us.
So look, the way to put it is it's still early days for them to come back in any meaningful way because it's not that they're not in love with India or they're giving up on India, etc. The holdings in India still remain sizable, somewhere in the range of $700 to $800 billion. They still engage with us regularly on bottom-up ideas and opportunities. They still make trips to India to look at opportunities. So the belief about the longer-term potential still remains there. Obviously, there have been some investors who've been more worried about the impact of AI or lack of AI in India, especially including the semiconductor part. But I don't think that fundamentally anything has changed where they really want to get out of India. I don't think so. What we need is two simple things. One, obviously, globally, we are in a period where the growth in the AI and tech-driven economies and markets are just very attractive. And linked to that, the valuations also are very reasonable. While India has seen a cyclical downturn over the last 2-3 years, we were seeing uptick in the last 3 to 6 months just before the Middle East thing broke out. And if this thing stabilizes and we go back to the growth which we are seeing early in this year, I think there will be enough opportunities to attract foreigners back. But yeah, for the near term, at least for the next 3 to 6 months, doesn't look like they're going to come back in a hurry.
Okay, all right. But as long as they're still interested in various pockets, that'll be good news. Gautam, if you had to pick up your top 2-3 themes that you're looking at, give us top 2 themes. I remember you talking about consumption, QSR, if I remember correctly. In the past, that was something that we had spoken about. Defense and some energy as well. Those are the themes that we spoke about 6 months ago. A lot has changed since then. Top two themes that you have to give us.
Yeah, I think those themes remain broadly similar. Nothing dramatically has changed. Consumption in a broad basket way, but including pockets in FMCG are looking interesting. Secondly, the entire industrial, defense, capital goods, but also with a focus on energy, which I mean power, whether it's renewable or the traditional ones. That's looking very, very interesting because these are the pockets which should not be impacted by what happens globally or the local cycle. And finally, financials still look interesting. Many stocks there are at attractive valuations, and I'm saying attractive on an absolute basis, not just relative basis, which is not easy to find in the Indian market despite the time correction we have seen. So financials is the other theme which still look very, very interesting from a risk-reward perspective.
And in financials, PSU, private banks, NBFCs?
So we don't have a sector-like strong view because every sector has an interesting idea. But if I had to consolidate our financial services analysts' recommendations, I would say the bias is towards privates and non-bank financials, the bias. And specifically, both private and NBFCs have enough absolute risk-reward opportunities.
The UBS team downgraded India to a neutral. I think that happened sometime in March. At what point, does the situation that's taking place right now, if it prolongs, warrants another round of downgrades?
So that downgrade came from the other part of the business, which is the wealth side. Our EM strategist in our business has been underweight India for, I think, more than a year and a half now. And that stance has still not changed. He remains underweight India in the EM context. And again, it goes back to what we discussed earlier. The mix of earnings and valuations is still not in India's favor on a relative basis versus EM.
So should we expect any returns for the Indian markets from here on, say, till end of the year?
Look, in Indian markets in general, when you have nominal GDP growth in high single digits or 10-11%, there should be some growth irrespective, right? But the rupee has already moved. So in that context, the dollar returns might be tricky. But we should see some returns from India. But in an EM context, we still remain underweight.
Pretty depressing talk for a Monday morning, Gautam. We should.
I would say depressing. There are always pockets where investors are making money and should make money.
Yeah, no. There's always as they say, there's always a bull market somewhere, right? So yeah, I mean, we've had pockets and maybe very niche segments. So talk to us about those where within the manufacturing universe, right? I mean, if you go down the list, there is stuff happening. I mean, and stocks have done well. It's not as if stocks have not done well. And I could pick out one or two, and you'd say, well, that's just one or two. I mean, it's not a broad swath of companies which are seeing rip-roaring rallies. Maybe it's gotten tougher in that sense, right? It's not a huge, big sectoral move, but there are moves still. Gautam?
Absolutely, and that's the point. And India is a very bottom-up stock pickers market. It has been and is still the case. There are enough opportunities as we discuss, and even though it looks less attractive on a Monday morning, there are enough opportunities bottom-up. Like even the last month and a half, we have seen how small mid caps have responded to things, first signs of stabilizing in the Middle East. So clearly, there's lots happening in terms of business growth, earning, and translating into earnings growth. So these mid caps, small caps, when you talk about, there are enough individual level, stock level opportunities, which is backed by actual earnings growth and attractive earnings growth. When I say India and underweight in the EM context, that's a more broader index level market phenomenon. That's where the risk reward in a relative basis may not be attractive, but pockets of the economy and markets, they seem very, very well placed even now. And having said that, the other point I'll point out is that when you talk to local investors here, again, the large mutual funds, but also when we talk or try to get intelligence around the local HNIs, etc., looks like there is a hope coming back or building up. So that's also interesting, and that showed up in the small mid-cap indices or stocks behaving the way they did in the last month and a half. So clearly, if the things stabilize in the Middle East, we could see some pickup in select sectors and stocks, as we discussed the themes which we like, But yeah, manufacturing at a broad sector level looks very, very well placed.
You know, I was just thinking IT services, Gautam, right? Now, that's a space which is beaten down. Nobody's looking at it. Maybe there are real problems and you should stay away. But have you looked at it really hard and maybe, you know, or because, you know, it's a space where I guess a lot of people just say, well, there's too much happening. Who's going to keep track of what new model comes through? And at some level, there is that. It's kind of too hard and too muddled and too fuzzy. So let it all settle down. You think that is what is happening here? Or it's kind of now well understood that structurally things are going to be tougher and low single-digit kind of growth rates is what we should continue to expect here? What's your sense?
It's a mix of both. I think it's a mix of both. It's too early to be sure. It's still muddled and fuzzy, as well as there are pockets of investors who have kind of given up on IT as a long-term opportunity. So it's a mix of both views out there. And I think our analysts track it obviously very, very closely because it's one of the sectors where there is still a lot of ownership and engagement by the institutional investors, both locally and globally, though globally investors have cut down their IT services ownership in a material way. I think what will be relevant from a tactical positioning also is one, do we see signs of earnings surprising positively? Because in the near term, there is an opportunity for some of the IT companies to pivot their models faster and actually benefit from the AI adoption. And secondly, I think the more relevant part, which there's a healthy debate out there, is valuations. Despite the correction the IT services are seen, compared to the peer group globally, they're still at a premium. So that's the other part of the debate and goes back to the same basic earnings and valuation debate. So at a holistic level, at this stage, not yet attractive risk reward given the uncertainty around how this evolves, and also a view, some part of the markets having a view that this could be bad news longer term. But yeah, we will look out for opportunities, and we have been recommending tactical opportunities when we see specific companies pivoting faster and therefore surprising on the earnings part.
All right, Gautam, great chatting with you. Thank you very much for joining in. May we speak in better times next time. Let's move on now. We've got lots of corporate earnings to track. So Bank of Baroda is the second management on the show now. Healthy set of Q4 numbers, strong growth, stable margins, better asset quality. We have with us Debadatta Chand, MD and CEO of Bank of Baroda, now joining in. Thank you very much, Mr. Chand, for joining in. This is Rima here. Let me begin with the bank raising the loan growth guidance to 12 to 14%, an increase of 100 basis points. What is driving that? And if you could particularly talk about gold loans, because that is doing very well. And even the corporate growth, after going through a flat patch, has bounced back smartly, 10% plus growth. So the overall numbers, the confidence that you get to achieve this, and these segments.
Thanks, Rima. You said right. We had one of the strongest quarterly growth in last 10 quarters as far as the advanced growth is concerned. And the advanced growth, as against the guidance of 11 to 13, the advanced growth was 16.2%. And the good part of why we assumed a higher advanced growth for guidance as far as 26-27 is concerned, reason being the deposit growth has been very encouraging as far as we are concerned. I think the deposit market, the money is coming back to the banking system. That's something very, very positive. Secondly, we have outperformed our guidance significantly in last year. And thirdly, the basic assumption of the geopolitical issue, we are slightly optimistic with regard to the timelines. So considering all the three factors, we upsized the guidance, the loan guidance by 1%. As against 11 to 13%, we made it 12 to 14%. Specifically talking about the corporate book, always we say the Q3 and Q4 are always productive for us. And because that allows us to significantly, and that's the busy season as far as the economy is concerned. And going like initially Q1 and Q2, slightly the growth was less, and ultimately we ended up at 11.2%. So I think in the same way, if you look at the overall economic scenario in terms of the demand and the area where we operate, particularly the renewable sector has done extremely well. Similarly, the ECLGS is going to give a boost up also this year. So I think we go by the same guidance of around 10% for the corporate loan. Gold loan, my base is low as compared to other banks. So in terms of percentage, it looks higher. But then as far as the asset quality overall, it looks very good as on today. So in the same way, we're still positive with regard to the gold loan.
Okay, all right. Hi, sir. Good morning. Good to see you. When you've reduced your dependence, I think, on bulk deposits, if I look at, the recent quarter, Could you tell us what kind of CASA ratio are you looking at, in the coming quarters, if you could help us out with that? And your CD ratio, I think, is holding at around 85% odd. Where is that one headed as well? If you could just give us some brief details.
Look, CASA has been one of the strong points as far as we are concerned, and we have been focusing on CASA for last many quarters. And if you look at my growth of the CASA is 9.8% and the saving is at 9.1%. And we have been the median of the bank's average. We are able to outperform that for last many quarters. We have strengthened the CASA in terms of product, process, service, everything, and that is what possibly is the outcome in terms of a higher growth. So the CASA percentage as on 31st March was 38.9%, which I believe is one of the top quartile in terms of the banks. You would have seen the number. At the same time, going forward also, I think we maintain the similar number. We don't give a CASA guidance, but always the bank's efforts has been to maintain the CASA. If you look at year to year, the loss of CASA is only, CASA percentage is only 100 BPS, 107 BPS, which is again one of the lowest cut that we have seen in the market. So in that way, our focus on CASA, both in terms of product, in terms of improving the processes, in terms of bundling products, in terms of getting into bulk tie-ups, I think those are the things which the bank continue to do. And in the same way, we'll be in a position to maintain around 39% going forward.
39%.
As far as the credit deposit ratio we talked about, globally, yes, we are at 85, but domestically we are almost at 83. So earlier also we said that we are comfortable operating in the range of 81 to 83 as far as the domestic CD ratio is concerned. The reason being, we have huge alternative resources in terms of raising to manage liquidity. We are one bank who raised the green infra some time back. We got a good response. We have been raising infra loan. We got also a lot of refinance from other institutions. So in that way, the resources are quite strong as far as the bank is concerned. We'll be comfortable operating, as far as domestic CD is concerned, roughly between 81 to 83 in that band.
So while you have guided for cost of funds to have bottomed out at 4.78%, generally your loan yields have been trending lower if I look at it over the last couple of quarters. When do you expect the loan on yield to go up? Because that can push up your NIMs higher.
You're right. If you look at, the good part happened in this quarter. The growth in interest income has been higher than the interest expenses. So that's something positive, and that's why the NI has gone up by 9.7%. My NIM has improved vis-a-vis the last quarter. So saying so, going by the current geopolitical and the consequent impact on the market, it looks on the liability side, the cost is going to be sticky. So last time we gave a guidance of reducing, but we are no more giving. The cost is going to be sticky therein. The moment cost is going to be sticky, possibly there may be realignment of rates happening both on the advances and also on the deposit. Subject the liquidity continues to be as it is. If the liquidity position improves significantly, possibly again we may see a lowering of both the yield and also the cost side. But they are all because the situation we are in is a particularly slightly different because of the geopolitical issue, and we need to factor that in. But as on today, what I look into, the cost on the deposit is sticky. We are not looking at any further reduction therein.
And the loan yield, I think it was 8% in Q4 FY26. It stays here?
There are two aspects here. One aspect is a repo linked, right? So as long as the repo is the same, the benchmark rate can't increase, but the spread can undergo a change depending upon the regulatory guidelines with regard to the time we can realign the spread. MCLR still, I would have seen it was sticky in terms of reduction therein. The only segment where I see a bit of a upward trend in terms of illegal, corporate book which is not aligned or which is not linked with MCLR. There is almost now 20-21% of the corporate book which is again non-MCLR, typically linked to T-bill, GSEC or any other similar rate. So that is a segment I am looking at where there can be an upward change happen in case the liquidity persists to be tight and the rate matrix also continue to be tight in that manner.
All right, let's focus on asset quality then, sir. Slippage went up a wee bit, though asset quality on the whole has been stable or in fact improved. Could you give us some guidance on that parameter? How do you see asset quality pan out and also on the slippage ratio?
Yeah, if you look at asset quality again, like on the business side, one of the best in last many years, I would believe, in terms of the asset quality. GNPA at 1.89, net NPA because of the floating provision of 1,500 crore, and net NPA now at 0.45. The credit cost excluding floating provision is at 0.32. The slippage ratio at 0.76. These are all within our guidance that we give. So going forward also, we maintain to keep the asset quality the same. It has been one of the strength of the bank for last many years now in terms of asset quality. But let us also factor in there is a geopolitical event which is again something beyond us in that way. So we need to factor in any impact coming big time because we run a large international book also. So considering that, we're not revising or improving the guidance with regard to slippage or credit cost. Our slippage ratio continue to be 1 to 1.25, although we have been consistently below that for last many quarters now. Similarly, the credit cost would be below 0.6. The credit cost for full year is 0.46. So in that way, I think I do have headroom in terms of guidance in case any geopolitical issue impacts the market big time. Otherwise, I think the journey of the bank in terms of improving asset quality would continue.
Got that. Mr. Chand, good morning, sir. Prashant here. Sorry, my question is not so much about the earnings bid. You would have heard the reports, etc., suggesting that maybe the Reserve Bank is looking at a dollar bond issuance through public sector entities, through PSU banks, PSBs. Have you heard anything around this, sir?
As on today, if you, as far as we are concerned, there is not much conversation on that. But then let me tell you also one thing. In a geopolitical, scenario like this, your reserve, the forex reserve is one of your key strength. And any measures to strengthen that is always something, the players like us or anybody can consider on that. So as on today, no conversation, but then, these are measures which can really boost up the forex reserve of the country. And bank like us are quite well positioned in that manner.
So this is not like the FCNR scheme, right? Back in 2013, what was discussed, right? That was a deposit scheme. This is debt in that sense, right? So
I understand dollar bond. We are talking about a MTN or a dollar bond issuance or any other measures like that. But then anything to augment the reserve of the country, where the money, you really bring that money back into India and convert into rupee. Yeah. I think that's something.
So this will,
always would be on the table, and I think bank like us can play a big role. But as on today, I have nothing.
I understand. We're just talking theoretically at this point, as you said. You're absolutely a point taken. So you would get dollars, right? You would issue bonds. You would give the dollars to the Reserve Bank. They would give you rupees, and you would hedge the dollars at a certain, I'm assuming, discounted rate with the Reserve Bank. Pay a certain rate of interest to the dollar holders, and then lend the rupees here in India, right? That's how it would work.
Plain simple, anything that brings dollar into the Indian economy is something that we do, and there are different measures available to do that. So, and currently, if you look at the scenario, is not very, like, we have seen scenarios which are very difficult at different points of time in the past decades.
Absolutely.
In that way, we're adequately cushioned in terms of any external shock in that manner. But I don't think anything, any measures that requires a intervention, something the bank would be quite, well positioned in that regard.
Yeah. Well, just one thing. Again, theoretically, because you'll have to offer a high enough rate of interest to attract these dollar deposits, would that kind of push up the cost curve for other Indian companies who have dollar debt?
Not necessarily. It doesn't. You have to offer a higher. See, like globally, we as a bank operate, right? We borrow big time with regard to the global borrowing, and the cost is very tight at this point of time. In the sense, very fine at this point of time. Recently we raised money, 500 million. So in that way, the only thing that I have to decide whether I keep the money outside or keep it back into India, right? So that's a scenario. So not necessarily somebody has to offer a higher rate to attract deposit, means bonds, debt outside India.
Okay, fair enough. I get that. But this would be technically debt on the books of banks, right? Of course, I mean, in a way guaranteed by the Reserve Bank, but that's how it's different compared to the deposit scheme. Just again, theoretically, if this were to happen, we don't know if it will happen or not. But
about any scheme purpose, what I'm talking about, is there a need for India or Indian entity to bring dollar back into India just to augment the forex reserve? There are multiple measures, multiple schemes therein, and at this point of time, I don't think any real scenario where there is because such scenario have been handled beautifully well earlier also.
The past as well.
If there is a need, we'll discuss. But as on today, as I said, there is no conversation as on today. If there is, bank like us are well positioned. That is what I said.
Got it, Mr. Chand. Thank you very much, sir, and thank you for taking those questions and sort of talking through it. As you said, and just want to make it absolutely clear, we're just talking theoretically with regards to some of the reportage which has happened. There is no discussion at currently on, but BOB saying that they're well positioned to facilitate something like this if this were to be done. Thank you very much once again for joining.
So I just add only a couple of points here. I mean, as a bank, we crossed 30 lakhs crore of business as on March 31st. And also our profit for the year exceeded 20,000 crore. And that's something I think two critical milestones the bank achieved in this year. Thank you very much.
Congratulations, sir. Congratulations. And wish you all the best of luck as you continue to execute. Thank you.
Thank you.
Okay, take a quick commercial break here. The management of Niva Bupa will be with us on the other side. Fourth quarter performance in focus. Stay tuned.
Welcome back. Well, the market's still under some pressure as we speak. We're actually at the lows of the day, but individual stocks are doing the thing of their own. And Niva Bupa Health, that's buzzing in trade today after reporting a good set of numbers actually in quarter four. The net profit was up more than 60%, strong growth in gross written premium, as well as net earned premium. So that explains why the stock is actually outperforming today. To help us out with what went on in the past quarter and the way ahead, we're joined by Mr. Krishnan Ramachandran, the MD and CEO of Niva Bupa Health Insurance. Hi, sir. Good morning. Good to see you win. Well, congratulations on a good showing in quarter four. What led to that outperformance that we saw in quarter four? And for this year, if you could give us your guidance, on 2-3 parameters that you're targeting for the coming year. Please go ahead.
Firstly, thank you very much for having me on your show, and it's a pleasure to be here. Look, rather than speaking of quarter four, I'd say any business is a continuity, and we look at our business not in quarters, but in what we need to do over longer time periods. And quarter four is really the outcome of the strategies that we've been executing, which you're probably quite familiar with, which is our focus on product innovation, on being a partner on healthcare journeys, our emphasis on multi-channel distribution, our emphasis on technology and analytics, talent, and so on and so forth. So really, it's the continued steady focus on inputs that I believe drive our ongoing performance. And quarter four, in addition, has definitely seen a tailwind from GST. In fact, both Q3 and Q4. So really, that's what, nothing specific about Q4, but really the outcome of a lot of the inputs that we've been consistently putting into driving performance with the company.
All right, let's focus on a couple of numbers. Then the gross written premium as well as the net earned premium. What's been the initial trend first in terms of a start to the fiscal, because April numbers would already be in? And give us guidance on both these two parameters for FY27.
So look, in terms of guidance, I prefer to talk again in terms of a slightly longer term rather than in year. And again, it's consistent with what we've said in the past that we believe we will grow 5 to 8 percentage points faster than market. Our expectation is retail, which is a big area of focus for the company, will continue to grow 17-18%. So to that extent, our growth CAGR over 5 years, would be between 23 and 25%. So that's broadly how we look at growth for the market and our growth in that context.
Okay. You're also looking to bring down your combined ratio. I think it currently stands at 101.4%, and you plan to bring it to sub 100%, 99%, I think, by FY29. How is that going to come about?
That's absolutely right. And the numbers you're quoting are on an IFRS or Ind-AS basis. And the good news, we've had a lot of noise in the past, and we've discussed that on the show as well, on how Indian GAAP is really not a good reflection of our economic value. So the good news on that front is Ind-AS has been notified, IRD has notified it, and we as a company, along with several others, will be moving on to the Indian equivalent of IFRS 17, which is Ind-AS. And our guidance, the 99% combined ratio number that you referred to by FY29, that broadly stays the same. 98, 99% is where we think we'll land at, and that translates into a mid to high teens return on equity. So we very much are on course to get there. And what will help us get there? Clearly, the big lever is going to be operating leverage. As we get larger and larger as a company, the costs on the renewal side of our book dramatically fall. And that is going to be a big lever, in addition to all that we do around operational expense management, using technology, driving AI. But the big lever is going to be really operating leverage.
Yeah. I got that. Just a quick word, sir. Morning, Prashant here. The distribution regulations, we understand we reported that's going to be pretty comprehensive, and it's going to come out by the end of the month. So it's going to be a discussion paper, consultation paper, and then, of course, there'll be feedback, and then probably something will be firmed up. But if you had to identify one or two things which you, and then this is obviously a consultative process, and you must be aware of what you as an industry have presented. Could you talk to us about one or two things really consequential?
No, I'll only make two comments. One is I do believe the single limit on expense of management has been a transformational reform. And this is our point of view as a company. I think my personal view is that there should be continuity on that. And, reform should be taking that forward. And I'm confident that I guess the second part I want to say is, whatever the regulator does, I'm confident we'll be keeping in mind the interests of all stakeholders. And as Chairman has repeatedly mentioned, in his public statements, it will be a process which will be gradual. It will not be disruptive. And of course, the interest of the policyholder will be kept in mind. So our belief is that whatever happens, whatever comes out will be...
Sir, is that it could be effort-based?
To be honest, I'm not aware of any, those discussions within the authority, and I'm not qualified to comment on that.
Okay, all right. We'll leave it there. Thank you very much for joining us. Good speaking with you. Good luck as you sort of continue to operate the business. Stocks up, by the way, 7% in a market which is not up, market which is down, 300 points lower at this stage. Market breadth is pretty negative. 650 odd stocks are higher, and about 2,300 stocks are lower. So it's pretty one way at this point in time. I think we have the management of Bank of India now joining us, and the stock should come up on your screen. So I think it was a good quarter for the bank across all parameters, I believe. Profitability is improved sharply, and provisions were lower, which essentially is delivered earnings growth, healthy earnings growth. We have the management now joining us. Mr. Rajneesh Karnatak is Managing Director and CEO at Bank of India. Sir, good morning. Good to have you with us here as always. Thank you for joining us. We are for 2 years now. Last year was the same in some ways. We've been waiting for the shoe to drop. The other two shoe to drop, but the shoe did not drop last year. I'm referring to last year. The big top-down macro watchers all saying there's a recession coming in the second half because of tariffs, etc. Not in India, but generally a bit of a setback globally. Nothing happened. Here now, expectations are that everything which is happening, which is a higher energy price, etc., will hit sometime in the second quarter. So just wanted to get that out of the way, sir, with some numbers, if you can, for your bank, for Bank of India. What are your expectations around, growth for FY27?
Yeah, thank you for having me here. So yes, for FY27, the growth numbers, like we have already grown, as you see that our global business has grown by 14% plus. Our global advances have grown by more than 15% plus, and global deposits have also grown by 13% plus. For FY27, we are saying that our global advances should grow at around 15 to 16%, and global deposits should grow at around 13 to 14%. That is our guidance, keeping in view the fact that the geopolitical situation is also there. But we feel that this should phase out by the next quarter, the second half of this financial year. And on the domestic side also, our advances growth has been more than 16%. If you see, the SCB growth is also at around 16%, and we have also grown by more than 16% as far as domestic advances are concerned. There also we are very confident that we should grow at around 16 to 17% in FY27. And as far as the domestic deposit is concerned, there we have grown at around 14% plus, and the scheduled commercial banks have grown as per the RBI data in March 26 at around 13% plus. So there also again we are saying that we should be growing domestic deposits at around 13 to 14%. Somewhere around 14% plus. We'll maintain that growth momentum in the domestic deposit also.
Sir, talking about your advances growth, I believe you're also targeting some of these high growth new gen sectors like green energy, data centers, rare earth to improve your margins. So how much does it currently contribute? Do you have a pipeline for these high growth new tech sectors that you are looking to target? And you also said that this will help you improve your margins. So what are the NIMs what are the kind of margins, yields that you can enjoy if you lend to these sectors?
As far as the pipeline is concerned, credit pipeline is concerned, we have a credit pipeline as on date of around 75,000 crores. Out of that, around 15,000 crore is the RAM advances, which is the retail, agriculture and MSME advances pipeline. And the remaining around 60,000 crores is the corporate credit pipeline, which also includes the new gen sector. Within that, I may clarify that we have around 20,000 crores of infrastructure pipeline also. So that includes, as you rightly said, the green energies which are there, data center is there, warehouse is there, pipeline thing is also there, which is also there. LPG pipelines are also there, wherein we have done certain fundings over there. EV is there, PV voltaic cells manufacturing is also there. And all these things contribute together to around 60,000 crores of corporate pipeline. So as far as the margins are concerned, we are very clear that good margins will be had when we shift more towards the MCLR advances, number one. So we are targeting more of MCLR advances and also the increase in the RAM advances where the margins are better and the NIMs are also better. And apart from that, we have 19 ECCB branches from where we are targeting mid-corporate advances also, which are the emerging corporates. For the fact that they give better rate of interest and also LCBG commission and process fee. So overall, with all these things, we are very confident that we'll be able to improve the net interest margins in this financial year FY27.
You've also, I think, promised to bring down slippages to 4,000 crore rupees. It currently stands at 5,500 crore. What will help you achieve this?
Yeah. So presently our fresh slippages in FY26 is 5,500 crores. I had said that we'll bring it down to 4,500 crores. That is the management target that we have kept for ourselves. This is at the backdrop of the fact that we have a very robust zonal collection center. If you see our fresh slippages, which were 7,500 crores in FY25, we have brought down them to 5,500 crores, and our fresh the slippage ratio has also come down to 0.83% only, and it has been brought down by nearly 30 basis point. So for the FY27, we are very confident that we will bring down the slippage ratio to somewhere around 0.55% for FY27.
Unfortunately, Mr. Karnataka, short conversation, but we've got lots of numbers to track, but this has been helpful. Thank you very much for joining in. That's the word coming in from Bank of India. Good set of numbers. Stock is up 2.5%. Now, moving on, MCX reported a strong growth in Q4 as gold and silver prices hit all-time high levels. Ms. Pravina Rai, MD and CEO at MCX, is now joining in. And we also have Manisha here with us to take us through that interview.
Well, thank you for that, Ms. Rai. Thank you so much for joining in as well. And the fourth quarter numbers have seen all-time highs in case of bullion, followed also by a sharp increase in volatility and volumes as well. Do take us through numbers and tell us on what commodities really contributed to this rise.
Certainly, Manisha, it's been a good year and a good quarter. All our segments have done well, but clearly, if I were to make a pick, then that would be the bullion segment. both gold and silver. So energy has always been a very important segment for us, contributing to throughput as well as the revenues. Now, bullion this year was a standout performer, and we are very happy that we now have two strong segments that hold up our portfolio.
Mr. Rai, do also take us through your numbers, and also after those tech disruptions that we saw in FY26 and much of that in the previous quarter as well, what concrete architectural changes have been implemented to ensure stability during especially the peak volatility sessions?
Yeah, I think all the numbers have more than doubled. So we're very, very delighted about that. If you look at the headline numbers at 2,429 crores, that's at a consolidated level for MCX in terms of total revenue, and the PAT at 1,332 crores. So both these numbers have doubled, and underlying to that is the daily throughput, which is really the fundamental parameter, and those numbers have increased by more than 2.5 times. So that's been very, very pleasing. Now, this has happened, as we spoke, on the back of growth across the segments. We spoke of metal, we spoke of the bullion, we spoke of energy, and we also saw a very good turnaround on the metal segment. You touched upon technology, Manisha. Yes, technology, when we spoke last time, if you remember, we said that we're going to get ready, and we were getting ready for a 10x growth. We spoke of 10 billion transactions a day, and we were at about a billion a day at that time. We've already seen and handled 2 billion transactions a day as the kind of peaks that we've seen in these quarters. So I will say that that journey towards 10x is very much on the way. Now, this has been delivered with a lot of work on technology, investments on technology, continuous improvements on technology, because this is not just simple, steady, slow volume growth. We're seeing spurts, and the kind of market requirement requires us to be able to handle those. So we've invested very significantly in the last couple of years to the tune of close to 400 crores. And we will continue to have those kind of investments in the year ahead as well.
Mr. Rai, while the previous quarter, of course, saw a lot of volatility, how has the first quarter of FY27 started so far? And if the volatility cools materially in FY27, how should then investors think about sustainability of current earnings and operating leverage?
I think early days are good, but of course, we will focus on discussions of last year. The fundamental baseline had opportunity for growth, right? So we've seen that sort of very healthy participation come in across user base, right from retail users, corporate participants coming in for more hedging, FPIs, domestic financial institutions, prop members. So if you look at the whole participation, it's been very healthy. And this provides a lot of resilience to the growth. So we're quite positive that each one of these segments has a growth opportunity. And that's what we're getting ready for this year.
And the latest one from the book here clearly has been the electricity futures, which are now live. What early participation trends are you seeing from utilities, generators, industrial users, and what more contracts are in the pipeline from MCX than the investors can watch out for?
Yes, I think electricity was a key highlight. This is a day ahead market, which really looks at a base load contract. So it really covers a 24-hour cycle on electricity. The simplicity of the contract is very beautiful, and I think it's been very well accepted by market. We see participants, including participants from producers to consumers coming onto the contract. So we may have other contracts also as we move forward within that segment itself. We see solar being a very, very significant component. The year has been a big one for renewable energy and solar for India. So that becomes a very critical play in the way this whole category plays out. So if you look at the energy category for us, we've got the crude oil and natural gas, and now we've got electricity as a base load contract, and we will look to actually fill this segment covering all parts of that portfolio. We've also, of course, been in the news, and we have announced the approval we've got from SEBI on the coal exchange. So that sort of sits there nicely, creating those synergies, though it will be a different entity working on that platform. We do have a healthy pipeline of products, and we will look at this across all our segments, as we always do, so that the need of the market in each one of these is addressed suitably.
Continuing with energy then, and the energy market share competition seems to be thickening, with other exchange with different expiry dates now into the market, eating into MCX's market share. How are you seeing that?
Yes, competition is thickening. There is a lot of opportunity here. The opportunity is really in identifying market needs and addressing them. India is a large market. We're growing fast. We have a number of segments where unmet needs are there. So as an industry, the more we explore segments where the industry needs hedging platforms, we need the commodity derivatives platform to operate. Those are really value-added activities. When we look at change of dates in existing contracts, which have very high level of depth and liquidity within MCX, that is a bit of a shallow play. And I think we are watching it closely. It's important. I think it's a very large player having these plans and following them through. So we will take actions. However, rather than reacting, really look at what the market requires.
All right. And finally, is MCX now seeing a structural increase in retail commodity participation, similar to what happened in equity derivatives over the last few years?
I think we are in early days. Commodity as an investment asset class is just getting understood. We've seen our traded numbers. While we do have a large number of UCCs on board, our traded numbers have grown about 60%. We're close to about 20 lakh users when it comes to the retail side. And if you look at the participation that one sees on the asset class on equity, there is a lot of headroom available here. I don't believe that everybody who is an equity investor will really find the knowledge base required on commodities, but clearly a lot of increasing interest and headroom for growth there.
Ms. Rai, Manisha, thank you very much for taking us through that interview. 23,900 on the Nifty is also gone. We're now inching towards the 300-point fall on the Nifty, while the Sensex already has sold off more than 1,000 points. Urban Company is down 10%, and the company in their call said that they're losing 447 rupees per order on InstaHealth as the competitive intensity has intensified with Snabit and Pronto raising significant amounts of money via fundraise. 447 is the loss per order on their domestic health business, InstaHealth. That stock is down 9.5%. Get into a break. We'll come back with more on the markets.
Welcome back. We've got the market, which is down 290 points. MK Surana is with us, former CMD, HPCL, and Rajkumar Dubey is former director, BPCL. Gentlemen, great to have both of you here. Thank you for joining us. Prashant this side. Mr. Surana, I was saying in the morning that I'm not wishing for a price hike, but kind of a bit of a mystery why we've not seen a hike so far. Maybe there were elections, but elections are also now, they wrapped up more than a few days ago. Mr. Surana, what's your sense, sir? Mr. Surana, I think line trouble here as well. Let me ask Mr. Dubey. Mr. Dubey, good morning. If you heard my question, sir.
Yeah.
Go on. You think a hike now, perhaps imminent?
See, if it don't, it has to show, this volatility has to show somewhere. Either it has to show in the petrol pump, or it would show at company's balance sheet, or it will show into government finances. That now it depends on how all the three things come together. So, eventually it has to show up somewhere. We cannot keep mitigating costs for in a longer term. for a short term, we did a wonderful job, in looking at managing supply somehow. And this time we were much better prepared than what it was earlier.
Yeah.
But now, having said that, that demand management is also important. And I mean, we heard the Prime Minister talking about, how you curb demand. So this would also, a transparency in pricing will also, bring in some kind of curbs in demand naturally. And also,
do you think, Mr. Dubey, do you think you will see actual sort of measures to rationing? I mean, that can mean a lot of things, but basically that kind of price hike is one thing. But do you think that like lots of countries have done, we could see some rationing as well if this goes on?
Lots of countries have gone in for direct price rise, ranging from 20% to 50%. I think we will have different mechanisms here. Depends on our fiscal conditions and, of course, how long these things continue.
So you've been in the industry for a long time. Have you ever heard the Prime Minister making this kind of an appeal to cut back on non-essential things, which can be done, whether it's work from home? We had that in COVID, but COVID was more of a demand issue, and this is on account of supply. And generally what happens? What is the signaling that the government is trying to give perhaps to the oil marketing companies with this?
There are two ways to look into this. One is a conscientious, way as a citizen, as a responsible citizen, we reduce, we know there's a crisis in the world. It is not in India, it's in the world. So therefore, as a conscientious, citizens, we would reduce our consumption, especially the unnecessary consumption, so-called. But the other part is also important, where when there is, the transparency in price, there is an incentive to shift, which there is always, there's always inertia to shift into other forms of energy. Now, this can be one way of, shifting it, slightly looking at a long-term perspective here.
Mr. Surana, the former CMD of HPCL, is also joining us on the show. Mr. Surana, many countries have undertaken price hikes of 20, 30, 40%, but India so far has held back. Are you surprised? And do you think, it's likely anytime soon? We've already seen a move on commercial LPG, but do you think pump prices are likely to go up?
Good morning. And no, not surprised that the price hike was not taken, because the government since last 4 years or so has maintained the prices the same, considering that probably too much volatility in the prices creates the inflation and impact on the macroeconomic factors. And therefore, I'm not surprised. But at the same time, we cannot shy away from saying that the constant under-recoveries on the part of OMCs does have a strain on their financials. And also, government has taken already excise duty cut of 10 rupees. So there is a limit to which the government will have a choice to bear the loss. So I think that longer it goes, the stress is increasing more and more, and rather at a disproportionate level. And I think there will be a limit to which it can be absorbed, and there will be a situation where it will be inevitable to take the price hikes.
I think the oil ministry already said, right, oil marketing companies are absorbing 700 to 1,000 crores a day. That's potentially 30,000 crore a month. As you said, at what point is this limit tested?
Yeah, actually, I also heard that the petroleum ministry has said that. Now, the question is that what is the actual amount of under-recoveries that will depend on what is the prices when the crude is brought, etc. But there is no denial that currently the price of the product is lesser than the cost of the raw material. And therefore, it is becoming more and more unbearable, and there will be a limit to which it can be done. And one more thing we should not forget, that currently we are having twin issues. One thing is the crude prices. Second is the exchange rate variation. So higher exchange rate has got the further stress. Every rupee increase in the exchange rate to dollar almost has the same impact as every dollar increase in the price of the crude. And therefore, we are having the twin whammy on that. It will also impact the liquidity of the oil marketing companies, because you have to pay to the crude for which you are procuring. And if we are not recovering it from the market, then it may lead to the liquidity issues also for the oil marketing companies in the longer run. In spite of the good and strong financials of the oil companies and the creditworthiness, for a long time, it does affect the short-term borrowings.
Mr. Surana, one is, of course, oil. The other is products, right? Diesel, ATF, and prices have gone absolutely skyrocketed. There was news about we've seen this before, maybe a 3-day ceasefire. It ends today, by the way. I'm talking about Russia, Ukraine. It's gone on for so long that we've just taken it as something we live with. Do you think if it actually ends, there is the ceasefire turns permanent? What in terms of energy markets, product or oil, will it make a difference?
See, I think the Russia-Ukraine war, the market had digested to be a going on things. And therefore, the immediate impacts you won't see. But one thing which worries is the damage to the energy facilities in Ukraine and Russia, which does have an impact on the overall oil market, global oil market. And therefore, the definite ceasefire there will help in reducing the risk premiums on the freight, on the insurance, and also the cost which gets built in because of the uncertainty if some of the dispatch locations gets impacted.
Sir, in such difficult times when the oil marketing companies, the industry is bearing such heavy losses, will there be a move perhaps to cut back on their capex or rethink the kind of dividend that they have been doling out? Is that a risk?
So the capex consists of two parts. One thing is when you are having a long-term projects, let's say you are a refinery, petrochemical complex, terminals, etc., which is already, if you are committed, then no purpose gets served in stopping the projects in between because it will only increase the cost and delay the projects. But every year there will be certain amount of capex which is taken, which is, let's say, with the timeline of 1 year, or maybe there's some of the non-essential capex which you take. There will be a recalibration of that. And when every year some new projects are also taken for a longer term, probably that may be a deferment to that extent in the capex cycle. But as you know, the oil industry projects are a bit long gestation projects and the longer view is taken rather than a very short-term view on this. So you may defer it, but you don't shelve those projects generally. And you may only reset the starting time or you may reset some of the activities on that. Like there is a whole lot of things which you do from office in terms of design, etc. You may delay the thing in taking it up on the ground.
And dividend risk, a dividend cut risk?
Dividend is between the government and the oil company generally. So it is a question of that. If the government is also bearing, oil companies are also bearing, then who has the shot to say that what can be cut and what can be paid? But yes, dividend is one of the things which will help the oil companies to retain some of the liquidity with them.
We'll leave it there. Mr. Dubey, thank you very much. Mr. Surana, thank you for joining us. And, we'll see what happens. Price hike, perhaps, the quantum, etc., staggered. That's the expectation. But, it depends on who you ask. But that's the chatter, that's the talk that anyone is having this morning. Markets, of course, are down about 300 points. The last I checked. Yeah, exactly 300. 23,874 on the Nifty. It's a wrap on this edition of Bazaar. Chartbusters will take the action forward. Stay tuned. Coming up.